Hi all, welcome back. In this video I'm going to talk about technical trading or technical analysis. So stock market trading is generally divided into two main categories. The first one being fundamental analysis and the second one being technical analysis. So fundamental analysis, which we're obviously going to talk about as well in a separate video, is about examining companies and their balance sheets and pretty much understanding whether it actually makes sense to buy these companies in regards to their P/E ratio, cash flow, and all that. But fundamentals are generally, or I would say widely, not used at all when we're talking about trading or we're talking about day trading, especially. Because for day traders, picture somebody who is actually sitting on a platform and they have to take quick decisions. First of all, the balance sheet doesn't really play any role because it's pretty much the same from one day to the next. So balance sheets are very important if you're a long-time investor, for example. But if you're a trader, what do you really have? I mean, how can you judge whether you should be buying in a location or you should be selling in a specific location? And we're talking about the stock price when I'm saying location. So let me explain a few things about what technical trading is, and I have spent a lot of hours and a lot of studying around that to understand the concepts. I have even done quite some of it myself. I was fortunate enough to to make money actually out of it, but it's not easy at all. And it does require, like, the most important thing after knowledge is how you handle your emotions. It's emotionally overwhelming. So the first thing that technical traders need to learn is this kind of charts, which is called candlesticks. And I won't give all the details because they don't really matter. But red means down, for generally speaking, and green means up for the day. And the difference between the higher part and the lower part is pretty much the distribution of price throughout a single day. And we're talking about the daily charts here. We can obviously go to other times, like hours, like an hour, 30 minutes. And for the most part, the day traders look at the daily when they prepare their day. And when they are actually trading, they're looking the minutes or 5 minutes, sometimes also three. But for the most part, it's like 1 minute and 5 minutes for the day trading stuff. So technical traders require to play stocks that are moving during the day. So Apple is not really one of them. They require stocks that have a lower float, as we say. A float is the amount of shares that can be traded, pretty much, that are available to trade. And if you are looking at a stock that has like a 1.5 billion float, which is like Apple, I think it's something towards that area. It's actually very tough to move the stock during a day so much that you could actually make a lot of money from day trading, unless you're trading with very high volume. So they generally go for lower float stocks that have more volatility, so they go up and down faster during the day, so that they can actually make money faster. But what are they really doing? There are a lot of books actually that describe technical trading, and I do have some of them. Um, Technical trading pretty much is about examining charts, like this chart, for example, here, the Apple chart, in order to find locations where the psychology of humans would suggest what the next move would be. That's pretty much what it is. And this establishes itself on the fact of how price is moving. And it does have some merit. I mean, you may be asking, does that actually work? Is it something that could actually work? And I would say that there are situations where it could work. You have to be super careful. You could make it work. It's really, really tough. The vast majority of technical traders are actually losing money. But there are some who do make, or at least they claim that they make. But it's a good idea to at least know some of the concepts if you look to trade. And if you look to be a day trader, you will probably be using similar techniques anyway. So why there is some merit to it? Look at this example here. So this is sort of like a channel that you could picture here. Let me actually make a trend here. So make a trend line. You could see that I'm not sure why this goes up and down actually. Okay, I probably zoomed for some reason. Anyway, so technical traders would look at this here, which is the daily chart, and design a channel, for example. And they would be like, okay, we're inside a channel and the price is moving towards that channel here, and we're expecting to have either a break up or a break down. So at some point it looks like it's breaking down here. So if they were in this day, for example this day here, and they saw that there's a break below this channel, which gets described by the previous price action, you see it's like the edges here, they would actually short for the day. And this would have worked for the day actually. As you see, Apple was down today, but they would go for more volatile stocks. Similarly, when the stock was going up, like if it started going up, they would actually buy at some point when it's about to break. And good technical traders tend to buy around this level, for example, or this level here. It is based on patterns. It is based on what they are seeing in the charts. And there's like flag patterns, bearish flags and bullish flags. There's like candlestick type patterns, red to green moves, green to red moves. I mean, I don't want to enter too many details because it doesn't really matter. I just want to make a quick introduction of what this technical trading actually means. And technical traders look at two things for the most part, price being their most important thing, and volume is actually the second most important indicator. You see that volume indicates a little bit of distribution here because it's actually red and it's higher than the average volume. So the average volume is here. So we're having a lot of selling in this past 4 days, potentially indicating more selling in some situations. However, there are also contradicting elements. For example, you notice this shadow around the chart, the blue shadow, the white shadow. This is called the Bollinger Band. It's a mathematical formula that attempts to show how stretched the price is towards one location, either the buy or the high or the low. So as you see here, the price has actually pierced, as we say, the Bollinger Band on the lower side. So when this happens, for the most part, traders expect that the price would bounce here, and piercing the lower or the upper Bollinger Band so massively, so forcefully, generally means an inverse play. So a technical trader would potentially, if they wanted to trade Apple, they would potentially be ready for an upwards movement tomorrow. Again, of course, this is not necessary. And it's not a clean chart as technical traders want to see cleaner charts. But they could have that in mind if they really wanted to take a look at Apple in this situation. So obviously, each chart tells a different story, and you can kind of see price levels, for example. So in this chart here, you see that the area around 8 to 7, around 8, yeah, and again here was an important area, right? So it was around here, then here, then here, and then it actually broke lower. So when it tried to pierce this area over here, there's like what they call like 3 taps, pretty much. So if you let me show you what I mean. If you take a look at the trend, pretty much at the trend line, and it's not perfect, obviously. I mean, this goes a little bit lower, but that can happen. So there was like one tap here, one tap here, one tap here, and then down, and this meant a massive down day actually, and now that the stock is actually trading on a different channel, and you could picture this as another as a continuation here, for example, and oops, let me get another trend line, and now it's actually exiting this channel here and moving downwards. So there's a lot of alchemies that you could do here. And why is that important for traders, you may ask? Well, I mean, what does that give? I mean, it does give them an idea of what they could trade for. Like, if you look at the chart at any given day, you may be like, okay, what am I doing? What's like my next play today? So is that a play? So what they generally do is the first thing that when they prepare their day trading, they look at the daily charts for various stocks. Like good day traders may be looking at a thousand stocks a day or so quickly, just by pressing like a space here and then moving to the next one, and then examining whether a stock is actually in play based on the chart they see. And they are looking for specific things, mainly trends, like things that go up, but they do have specific areas of what that means. So for this one here, they may be, you see that this thing goes up, so the overall trend is continuing upwards. So what they could be waiting for is a type of consolidation. For consolidation meaning this type of action, for instance. So pretty much going sideways. And once they see that they may be monitoring. And the moment the price actually goes above that area here, they could be buying and pretty much buying the breakout on that day. And on the specific day that they are looking at, they may be looking at the 5-minute chart and basing their actions off of that, the 5-minute chart. So they are trying to align the daily chart with their intraday, as we call, chart. And obviously there are other very important ideas like the moving averages. And the moving average, for example, is let's say let's go for the 20 moving average for a 5-minute. It actually would show how the trending line of the average. They would plot the average of the 20 latest 5-minute prices, pretty much. It kind of plots an average and show you how the price is actually moving. And there's also the VWAP, which I'm not gonna be talking too much about because it could be a separate video even. But the VWAP is another thing that's being used a lot. And intraday, you see that price is actually moving around the VWAP. So you see that goes down, then goes back to the VWAP, continues, then down again close to the VWAP, then up, and then again back to the VWAP. So you will notice that a lot. There are actually traders that only trade on the VWAP, the volume weighted average, as it's called. And again, you see here that it's almost like a magnet, like it goes back. So it's obviously one of the elements that they are using, one of the indicators, as we say. And for example, you see here the 200 moving average, which is this line over here, 200 days, because we're in the daily chart now. So traders would consider this bearish if the price goes below that line, like 159.18 for Apple. They would consider the start of a bearish movement, pretty much, of a big bearish movement. So going down, like breaking the floor, pretty much, as we say. Moving down, this would potentially indicate a more bearish movement even, or if it would actually come over here, maybe pierce it a little bit and then come back, this would actually be a bullish movement. So they're actually looking to see what's happening with the price in order to take their decision. So if they see that the price goes down and then remains down, they could be shorting the stock. If they see that it bounces, they could be longing the stock. That are some of the important ideas about day trading, and there is really a lot. I mean, there is really a lot to it. If you are interested in the area, there's literally thousands of books, and there is so much information to study. I would say one thing: if you really want to mess with it and intraday try it, be very careful. It's the most important thing is obviously knowledge is important, but the most important thing by far when you're day trading is your sentiment, is how you're feeling, like how can you actually be disciplined. So discipline, I would say, is the most important thing, because if you say that you're buying, you should be buying. If you say that you're selling in this level, you should be selling in this level. So for example, if a trader bought here, let's say, and the price didn't move up and actually went down, at some point they had to exit before realizing massive losses. So their exit point could potentially be this area here where it actually goes below the previous channel, the small channel here. And yeah, there's a lot to it really. Yet normally you see something like, let's say, some price action which is like this, so it goes like this, right? And at some point the price, you enter here, let's say, so the price goes here, and you're fine, or continues over here, and you're staying within the break of the price. But if you actually bought in on these levels, where do you exit if the trade goes against you? So if you were on this channel, you have to exit when the price goes here, for example, and so when it breaks your channel and could potentially move even down, even more down. So and ideally you want to have some risk reward. So for example, you are risking $100, let's say. Actually, let me get it right. So you're risking $100 here in order to make $200 here. So it's like a 2-to-1 risk ratio in this situation. 2 for the reward and 1 to risk. That would mean that if you have a risk of losing 50 to gain $100. So you could lose 2 trades before being even by winning 1 trade. And in this situation, you would have a lot more. You're actually, I would say that the chances will be stacked for you. Obviously, it's not so simple, but that's the idea, and that's what they're playing for when they are technically trading. And it could be like 3 times even, and 3 times as like 3-to-1, for example. And there's day trading. There's also swing trading, which is like trading for like getting a security and then trading it for after a week or so. So it's like holding for a few more days, and these holds tend to be a little less volatile. Swing traders prefer the less volatile stocks, still volatile but less volatile than day traders, and stocks that don't make like super massive moves because they're holding overnight. They do sometimes, but it's probably not the best idea. But yeah, that's pretty much it in terms of a simple and quick analysis about technical trading. Again, there is massive things that you could be describing. If people are interested, I can give a lot more information about technical trading. But yeah, I think it fits your arsenal of knowledge to know at least what this is, and even if you're a fundamental trader or a fundamental investor, I would say, which is more proper, like I am, at least at the moment, you would prefer to stay with the fundamentals instead, and not go towards technical stuff. But you have to know that price movement during the days, or even during the week, is mostly about technical trading, and this could even mean that technical trading based on news even. But it's definitely more about technical trading and not fundamentals, because fundamentals don't matter over a week; they matter over a year or multiple years. So that's why long-term investing is a safer choice, generally speaking, and always depends on the stocks, of course. But we're gonna have different lessons on that and different video tutorials. That's it. Thanks for watching, and I will see you soon with more videos. Bye.